Welcome to the Rudick Report. Today is Wednesday, March 22nd, 2023. If you can, please like this video and please help support this channel by buying me a cup of coffee or by visiting my affiliate links. Your support will help this channel continue to provide content. This week, we saw the merger of Switzerland's largest lenders, Credit Suisse and UBS. As a result, the stock market cheered, but the truth is, the recent buyout could have massive financial impacts on the entire Western bond market. UBS agreed on Sunday to purchase its competitor, which was essentially insolvent due to the loss of investor and customer confidence, for 3 billion Swiss francs, or about $3.24 billion in stock. The deal, brokered by Swiss authorities, came with a 9 billion franc government guarantee for potential losses from Credit Suisse assets and 100 billion francs in liquidity assistance from Switzerland's central bank. Nevertheless, as part of the agreement, Swiss financial market regulator FINMA ordered Credit Suisse to write down to zero 16 billion Swiss francs, or 17.24 billion of its additional Tier 1 AT1 bonds, with the goal of bolstering the bank's capital and resolving its liquidity problems. A write-down is performed in accounting to reduce the value of an asset to offset a loss or expense. A write-down becomes a write-off if the entire balance of the asset is eliminated and removed from the books altogether. AT1 bonds are essentially bank debt with more risk. They were created during the financial crisis of 2008 and represent a type of junior debt that allows banks to transfer risk to investors instead of taxpayers in cases of financial difficulties. Investors find them more attractive because they pay higher interest rates because they carry more risk than regular bonds. So in this scenario, the decision makers involved in this buyout have screwed the bondholders and left them with nothing, while the Credit Suisse shareholders will receive $3.23 billion in the deal, despite the fact that bonds traditionally rate higher in banking hierarchy than equities do. This arrangement has angered the bondholders, who now say that regulators in other countries may follow the Swiss government lead. Jerome Legrasse, the head of research at Axiom Alternative Investments, who is an investor in Credit Suisse, stated, "It's stunning and hard to understand how they can reverse the hierarchy between AT1 holders and shareholders. Wiping out AT1 holders while paying substantial amounts to shareholders goes against all the resolution principles and rules that were agreed internationally after 2008. Patrick Kaufman, a fixed income portfolio manager at Aquila Asset Management, who also holds the bonds, commented that, "This just makes no sense. Shareholders should get zero. It's crystal clear that AT1s are senior to stocks." So again, the shareholders are bailed out and rewarded while the bondholders lose everything. It is blatantly obvious that the banking crisis continues, and it is affecting funds that have been buying bonds. Allianz, a subsidiary of PIMCO, one of the largest asset managers in the world, is writing off countless millions with Credit Suisse bonds. As a reminder, a write-down is performed in accounting to reduce the value of an asset to offset a loss or expense. This happened when market value of these bonds dropped below their book value. Ultimately, the write-down impacts the balance and income statement of a company and ultimately affects the business's net income and retained earnings. The banking crisis has been the result of artificially low interest rates for far too long, and banks were used to the free money and took advantage by buying long-term bonds, all because they were making their money on the spread or the difference in price between the buy bid and the sell offer prices. Now that rates are rising, their process of identification, analysis, and their investment strategies were non-existent, and as a result, the losses were widespread. Personally, I feel that the taxpayers are getting shafted here. They shouldn't be the ones to take on this burden of the bailouts. Investors should take all the loss. They are the ones investing. Taxpayers who do not have bonds, deposits, or shares in the failing banks have nothing to do with it. This stinks of more government involvement in the nationalization of the banking sector, which stinks of socialism. Thanks for listening. Until next time, this is the Rudick Report.